What if there was a way to determine future home price movements with heightened accuracy? Imagine the power that kind of knowledge could bestow upon its beneficiary. We're not talking about predicting the future with 100% efficiency. That's impossible in our estimation. We're discussing the possibility of enhancing one's forecasting abilities using statistical analysis, math. We're not going to tell you that obtaining this kind of proficiency is effortless, but it's not impossible either. If statistical analysis isn't your thing, like most people, you could partner with someone like us and reap the incredible benefits that quantitative analysis has to offer. After all, machine learning, developing algorithms and models is the way of the future. Even those who simply want to own their own residence can benefit incredibly from discoveries divulged from statistical modeling. Knowing the best times to buy and sell could equate to hundreds of thousands of dollars in additional savings and profit, even in the short term. However, real estate flippers and investors will find it increasingly necessary to utilize data science to stay ahead of their competitors who will undoubtedly be incorporating predictive analytics with greater frequency from this point on. Let's get into some examples to illustrate the effectiveness of future price trends analysis. This illustration is the historical quarterly seasonal component of the King County median prices from 2012 to present. We started in the first quarter of 2012 because Q4 of 2011 and Q1 of 2012 marked the bottom of the median prices in King County following the bursting of the housing bubble. We won't get into the minutiae of how we arrived at the quarterly seasonal component, as it would be extremely time-consuming and our subscribers and viewership are too low for the time being to get into that level of detail. Perhaps in the future, if we can grow the channel, we'll get into the finer points of how to extrapolate the data for the do-it-yourselfers. For now, realize that the first and fourth quarters recorded median prices below the baseline, while the second quarter catalog price is 4.31% above the baseline. So, simply buying, closing in January, and selling, closing in June will put you ahead of the game by 5 to 6 figures in only 6 months or less. Just be aware, this is a gross generalization as we're talking about median prices here, but realize you can find even better performance in specific MLS map areas, or get your proverbial head handed to you in other MLS map zones. And prices are constantly changing and rarely if ever stagnant. In most cases, flippers will need to get their projects done in 3, maybe 4 months. Theoretically, you'd close in January and be on the market no later than mid-April to mid-May, depending on market stimuli. Alternatively, properties could be closed earlier, November through December, and that would give flippers an additional 1 to 2 months to get their projects done before the markets peak in May through July. After July, however, demand tends to wane, and multi-offer scenarios are not nearly as prominent as they are in March through June. This illustration emphasizes the gains possible over 1.5 quarters and 2.5 years and 5.5 years. The extra 1/2 quarter and 1/2 year is assuming a purchase in January, as in the previous example, and selling in June, which is the high water mark for prices on average from 2012 to 2024, at least for single-family residences in King County. The quarterly information is useful for flippers, and remember, some of these gains could come from utilizing OPM, other people's money. Also, these figures aren't factoring additional returns stemming from upgrades, improvements, and labor. Those numbers are strictly appreciation over the respective time periods. Moreover, if flippers are unaware of the influence of seasonality, those potential profits could then be diminished owing to the time of year effect. If you've ever seen a house flipper lose money, seasonality combined with mounting total active listings, which many flippers are also oblivious of, is likely the cause of their setback. We also use 2.5 years as a minimum yearly starting point because of IRS's topic number 701, sell of your home. Topic 701 states, if you have a capital gain from the sale of your main home, you may qualify to exclude up to $250,000 of that gain from your income, or up to $500,000 of that gain if you file a joint return with your spouse. You're eligible for the exclusion if you have owned and used your home as your main home for a period aggregating at least 2 years out of the 5 years prior to its date of sale. You can meet the ownership and use tests during different 2-year periods. However, you must meet both tests during the 5-year period ending on the date of the sale. There's a lot more to topic 701 and additional links, so we encourage you to enter IRS topic number 701, sell of your home, into your browser and read the topic for yourselves. We know people who take advantage of this exclusion as often as possible. As real estate agents, our objective is to get our buyers and sellers the best possible price at any given point in time. To accomplish this goal, we not only analyze comparable sales at the moment, but we also examine the historical record looking for patterns that could benefit our clients. For example, if a buyer is continuously being outbid when demand is at its peak, typically March through July or August, then trying again in the fall or winter when demand is at its lowest levels might be a better strategy for this buyer. Multiple offer scenarios are less frequent during this time period, though still a factor to be considered. So, the issue is price and the market stimuli that drive demand. Quantitative models help to identify patterns and trends within the data that aid in establishing which indicators have the best correlation to price. And as we often say in many of these videos, the premier price indicator is total active listings. We utilize Pearson's correlation coefficient to measure the various MLS indexes to home prices and found the relationship between active listings and price to be a negative one. This means that as total active listings rise, home prices tend to decline. But we've drilled down even deeper, incorporating time series sequences, which is a form of predictive analytics. Time series analysis is the process of examining and modeling data points to uncover underlying patterns, trends, and relationships. This can help in forecasting future values based on historical data. While discussions of moving averages, exponential smoothing, and autoregressive integrated moving average models known as IIIMA are boring to most, many successful individuals and businesses have leveraged some of these techniques to gain a competitive edge and generate substantial revenue. Here are a few notable examples. As we said earlier, quantitative modeling is the way of the future because it provides a structured way to handle large amounts of data and helps in making statistic-driven decisions. Predictive analytics can help anyone who incorporates it to be more competitive. The average buyer or seller will know the best times and places to contractualize if their agent possesses the right knowledge. Agents who don't understand seasonality, historical patterns, and active listing thresholds are putting their clients at a strategic disadvantage. However, the renovators and flippers will find it more and more necessary to adopt predictive analytics to stay ahead of their rivals. This is even truer of the smaller scale investors who lack the budget to hire data analysts. The modest rehabbers will need to get into the data-driven forecasting game or be forced to compete over the scraps left by the more prepared. Here's an example of what forecasting, specifically time series, has to offer. The green line is actual prices, and the green star takes us through the second quarter, ending in June. The blue line is the moving average or the baseline, and the red line is the forecast. The period between 2012 to 2024, the forecasted price averages within 0.04% of the actual price. That's tight. The forecast tends to range, however, between -5 to 5% of the actual price, with some notable exceptions. The biggest difference between actual price and forecasted price came in the second quarter of 2022. The Fed started hiking rates in March of 2022 a quarter point. This marked the beginning of the fastest rate hiking cycle in American history. We'd warned buyers on our blog in January of 2022, writing, "The worst case for buyers. If you're a buyer, imagine rising interest rates and the simultaneous continued home price appreciation owing to persistent inflation." And this is exactly what happened. Moreover, the Fed had been indicating they were poised to begin raising rates soon, and thus some of the looming rate increases were already baked into the cake, so to speak. The Fed's timing of interest rate increases couldn't have come at a worse time for buyers at the beginning of the second quarter when home prices normally begin their seasonal climb. Then the Fed raised rates a half a point in May and another 3/4 points in June. This created a house buying rush as buyers went shopping in a low volume environment while simultaneously wanting to stay ahead of the impending rate hikes. All this propelled home prices ever higher. According to Freddie Mac's compilation of weekly survey data, mortgage rates are 6.47% at the current moment for a 30-year fixed-rate mortgage. The same week in 2022, fixed-rate mortgages were 5.22%. July 2024's King County median price was $109,000 higher than July 2022's, with an interest rate 1.25% higher now compared to 2022. This is a payment of $652 more per month now compared to 2022, $7,824 a year, an additional $39,120 after 5 years. The highest King County median price came in May of this year when the figure hit $1,001,000, the highest King County median price ever. And that's the first and only time King County's median price exceeded $1 million in any given month. Our time series dataset is currently forecasting a second quarter King County median price of $1,035,918. Let's see how close that is next year. A lot can happen between now and the end of June 2025, and we'll continue updating our models and algorithms as fresh data comes in. But I think our viewers will agree that our reporting is phenomenally more accurate than the firebrands on social media platforms who've been calling for a housing bubble 2.0 for the past 4 years and running. This is because we offer data interpretation versus sensationalism and gross exaggeration. We're expanding our business into additional disciplines, more consulting, looking to partner with flippers and renovators, and private money lending. We still offer brokerage services for our buying and selling clientele as well. Thanks for watching. We always appreciate your time.